On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. There's a lot of great investment wisdom and advice out there. Ensure you're well diversified, stick to quality assets, make sure you don't overtrade, and do your best to keep fees to a minimum. Those are a few examples, and they're all very, very good ones. One of the most important, however, especially when it comes to shares or any growth asset for that matter, is to maintain a long-term view. Now, that can be really difficult, especially during periods of uncertainty, which can come very frequently. However, it really is a non-negotiable if you want to be a good investor. If you don't feel that you can stick it out for at least 5, if not 10 years, then the share market is not the right place for your money. Because the thing with share investing is that the further ahead you look, the more predictable things become. That's kind of backwards compared to just about everything else in life, isn't it? Because we usually have a pretty good idea about what we'll be doing today or tomorrow or next week or even next year. Things start to get murkier though as we look ahead further than that. Now, the share market is the opposite. It's actually much easier to forecast the 5 or 10-year returns than to predict where markets will go next month or even next year. Let me share a few numbers with you to highlight why this is the case. Since 1950, the annual return, including reinvested dividends, the annual return from US shares has been 11.4%, and the market has been up in 57 of those 75 calendar years. Now, that's a really impressive return over time, 11.4%, and it's also a very solid hit rate over several decades, 76% in fact. However, over shorter timeframes, the variations have been significant. Using monthly data for the US share market going right back to 1950, if you look at all of the 12-month periods you could have potentially invested in, the best return in any one 12-month period was 60%. That came in 1983. The biggest decline was 41%. That came during the GFC in 2008, 2009. So massive variation, isn't there, from very good to very bad. And that's why nobody should ever be investing in the share market with a 1-year view in mind. However, things look a whole lot less scary if we start grouping those returns into rolling 5-year or 10-year periods. That's my preferred time frame to keep in mind, 10 years or more. That is much more sensible. When we do this, the proportion of positive returns jumps to 97%, while the range of best and worst outcomes per annum narrows significantly. The best is 20.8% per annum over that period, and the worst is minus 3.6% per annum. That came at the worst point of the GFC, as did the 3% of returns that were negative. That was also during the depths of the GFC. Now, if you move to rolling 15 or 20-year blocks, share investing starts to look very straightforward. US shares have delivered positive returns 100% of the time, and the best per annum return over a 20-year period is 17.8%, and the lowest is 5% per annum. So things start to narrow up dramatically, and there's much, much less variance between the potential returns. The results are very similar for New Zealand shares. If you look at quarterly returns for our headline indices going back to the 1960s, you'll find that the market is up 79% of the time over 12 months. And over those 60 odd years, the annual return has been an impressive 9.4% per annum. However, just like the United States, the volatility can be massive over short timeframes. The best 12-month return over that period has been a gain of 117%, the market more than doubling in just 12 months, while the worst was a fall of 49%, the market being cut in half almost over 12 months. Unsurprisingly, those big swings came during the wild west of the 1980s, but thankfully, the domestic share market has changed dramatically since then. If we exclude the 1980s, the best 12-month return is 51.7%, and the worst is a decline of almost 36%. So those are still very, very volatile. And the lesson is exactly the same as the United States, because when we look at 10-year holding periods since the 1960s, the market has never been down. It's got a 100% track record of being up. So this is the secret. It's just about maintaining a sensible investment time horizon, and then your chances of success will increase dramatically. The returns you can expect will also become much, much more predictable, and you'll get away from those big swings in either direction. A well-constructed share portfolio will always perform well over the long term. The hard bit is keeping that in mind when there is a very long list of things to fret about in the here and now. And trust me, there always is. No matter what the conditions, no matter what the backdrop, there's always a long list of things to worry about. That is normal. That's why I said it was simple, but I never said it was easy. Thanks for listening. We'll talk again soon.
For more insights, visit craigsip.com.